Right now, the crypto market feels confusing. It's a sentiment that echoes across trading forums, social media platforms, and private conversations among investors. There's a palpable tension in the air, a sense of profound uncertainty that has settled over the digital asset landscape. We are adrift in a sea of conflicting signals, where the traditional signposts that once guided market participants seem to have lost their meaning. The old playbooks, the ones that worked in previous cycles, feel outdated, almost naive in the face of the market's current behavior. This isn't just a feeling, it's a reflection of a market in a state of complex transition, caught between powerful, opposing forces. It's a period where conviction is hard to find, and even harder to hold on to. The noise is deafening, but the signal is faint. And it is this very ambiguity that makes a clear, dispassionate analysis more critical than ever before. We are navigating a new territory, and the first step is to acknowledge that the map we used to rely on may no longer be accurate. Prices are not crashing the way many expected, but they're also not moving with the confidence of a full bull market. Every rally seems fragile, built on a foundation of sand, ready to be washed away by the slightest shift in sentiment. Each upward move is met with skepticism, with participants constantly looking over their shoulder, waiting for the other shoe to drop. Conversely, every pullback, no matter how shallow, sparks a disproportionate wave of fear. It triggers anxieties of a deeper correction, a return to a prolonged bear market that many believe we have left behind. Social media, the modern town square for market discourse, is a perfect mirror of this internal conflict. It is split between extreme, almost euphoric optimism and a deep, pervasive pessimism. One camp sees new all-time highs just around the corner, fueled by institutional adoption and technological breakthroughs. The other sees a fragile house of cards, propped up by unsustainable leverage and macroeconomic headwinds, ready to collapse under its own weight. There is very little middle ground, very little nuanced discussion. You are either a moon boy or a doomer, and this polarization makes it nearly impossible to form a rational, independent perspective. And that confusion, that pervasive sense of being caught in a crosscurrent, is exactly why this moment matters. It is in these periods of peak uncertainty that the most significant opportunities for learning and strategic positioning arise. When the path forward is not obvious, when the crowd is divided and emotional, that is the time to step back from the noise and focus on first principles. This is not a market for impulsive decisions. It is a market for deep, methodical analysis. It's a time to sharpen our tools, refine our frameworks, and understand the underlying mechanics that are truly driving price action, far beneath the surface-level drama. This confusion is a signal in itself, a signal that the market is consolidating, absorbing new information, and preparing for its next major directional move. The winners in the next phase will not be those who guessed correctly, but those who understood the structure of the market during this period of indecision. They will be the ones who prepared, who studied the flows of capital, and who comprehended the shifting psychological tides. In this video, we're going to take a calm, structured, and realistic look at what is actually happening in crypto right now. We will deliberately filter out the noise. There will be no hype. There will be no sensationalist predictions of astronomical price targets or catastrophic crashes. There will be no promises of guaranteed outcomes. Instead, our focus will be squarely on the objective, verifiable data. We will dissect the market's anatomy piece by piece. We will explore market structure, identifying the key levels of support and resistance that are defining the current trading range. We will dive deep into liquidity, the lifeblood of any market, to understand where it is coming from, where it is flowing, and how its presence, or absence, is influencing volatility. We will analyze market behavior, looking at the patterns of accumulation and distribution among different cohorts of investors. And we will build a framework for understanding risk, not as something to be avoided, but as something to be managed intelligently. This is about replacing emotion with evidence and speculation with strategy. To do this, we will cover a wide array of interconnected topics. We'll start with Bitcoin, the market's gravitational center, analyzing its dominance, the behavior of its derivatives markets, and the impact of new financial products like spot ETFs. Then, we'll venture into the vast and complex universe of altcoins, segmenting them into their distinct categories, from Layer 1 protocols and Layer 2 scaling solutions to the burgeoning sectors of DeFi, AI, and Web3 gaming. We will also connect the crypto-native world to the broader global financial system, examining the powerful macroeconomic forces at play. We will look at how interest rate policies, the strength of the US dollar, and global liquidity conditions are creating headwinds or tailwinds for the digital asset class. We will explore the concept of market cycles, not as a rigid, repeating pattern, but as a flexible framework for understanding shifts in investor psychology. We will investigate why this particular period feels so unstable and choppy, even when prices, on the surface, appear to be relatively strong. It's about understanding the complete picture, from the on-chain data of a single asset to the policy decisions made by central banks half a world away. It is crucial to state this clearly from the outset. This video is not about telling you what to buy or sell. It is not financial advice. The goal here is not to provide you with a list of hot picks or to encourage any specific action. Rather, the sole purpose of this analysis is to empower you with knowledge and a more sophisticated mental model for interpreting the market. It's about helping you understand where we are within the broader context of the market cycle, why it feels the way it does emotionally and psychologically, and how markets typically behave during these transitional phases of high uncertainty. Think of this as a guided tour through the market's engine room. We will look at the gauges, check the pressure levels, and understand how the different components work together. By the end, you won't have a prediction for the future, but you will have a robust framework for interpreting the present. You will be better equipped to ask the right questions, to identify the most important signals, and to navigate this complex and fascinating market with greater clarity, confidence, and discipline. Let's begin. One of the biggest reasons the current cryptocurrency landscape feels so unfamiliar, so strange, is because the market is a confluence of participants operating with deeply mixed and often conflicting expectations. This isn't just a minor disagreement on short-term price direction. It's a fundamental divergence in how different groups perceive the very nature of the market itself. We are witnessing a tug-of-war between historical precedent and the argument for a new paradigm. This creates an environment of heightened uncertainty, where traditional signals can feel unreliable and the path forward seems obscured. Understanding this psychological friction is the first step toward navigating the complexities that lie ahead. It's the foundational context for everything that follows. On one side, you have the cycle veterans. These are investors who have witnessed the boom and bust rhythms of the past. They are expecting a continuation of these established 4-year cycles, often anchored to Bitcoin's halving events. Their framework is built on historical data, pattern recognition, and the belief that human psychology, driven by greed and fear, remains a constant. On the other side, a growing cohort believes that the crypto market has fundamentally and permanently changed. They argue that the influx of institutional capital, the launch of spot ETFs, and the increasing integration with the global financial system have broken the old models. For them, this time truly is different. And in the middle of these two camps are the majority of market participants, individuals reacting emotionally to the volatile, short-term price movements. They are caught in the crossfire, swayed by daily news headlines and social media sentiment, often operating without a firm grasp of the broader, structural context that is shaping the market. This emotional reactivity adds another layer of volatility, creating sharp, unpredictable swings that can challenge even the most seasoned investors. It is crucial to remember that crypto markets are still, in the grand scheme of financial history, relatively young. They lack the decades, or even centuries, of data and established institutional frameworks that underpin traditional markets like equities or bonds. This youthfulness makes them inherently more sensitive. They are more susceptible to rapid shifts in liquidity, where the flow of capital in and out of the system can dramatically alter prices. They are more vulnerable to swings in market sentiment, which can be amplified by the 24/7 nature of the market and the global reach of social media. And, most importantly in the current era, they are far more exposed to the powerful currents of global financial conditions than ever before. This sensitivity is a double-edged sword. It allows for periods of explosive growth, but it also introduces a degree of fragility that is less common in more mature asset classes. In the past, crypto cycles were largely driven by their own internal dynamics. The narrative was simpler, more self-contained. The Bitcoin halving, a pre-programmed reduction in the new supply of coins, served as a powerful catalyst, creating a supply shock that reliably preceded major bull runs. These were followed by waves of retail adoption, fueled by media attention and the promise of life-changing wealth. Speculative growth was the primary engine, with capital flowing from Bitcoin to other, newer altcoins in a predictable pattern. The crypto market was, for the most part, an isolated island, with its own unique ecosystem and rules. Today, that island has become a peninsula, deeply connected to the mainland of global finance. The capital flowing into crypto is no longer just from early adopters and retail speculators. It now includes some of the largest asset managers and financial institutions in the world. This integration means crypto can no longer be analyzed in a vacuum. Now, macroeconomic factors are not just background noise. They are primary drivers of market behavior. Interest rates, as set by central banks like the Federal Reserve, directly impact the cost of capital and the attractiveness of risk assets like crypto. When rates are low, money is cheap, and investors are more willing to speculate. When rates rise, the opposite is true. Inflation expectations also play a critical role, shaping crypto's narrative as a potential hedge against currency debasement. The overarching policies of central banks, whether they are injecting liquidity into the system through quantitative easing or withdrawing it through quantitative tightening, create powerful tailwinds or headwinds for the entire crypto space. And the performance of traditional equity markets, like the S&P 500, now matters immensely. Crypto has shown an increasing correlation with tech stocks in particular, meaning a bad day on Wall Street is often a bad day for crypto as well. This profound connection to the global macro environment makes the crypto market infinitely more complex. The number of variables an investor must consider has multiplied. It's no longer enough to understand on-chain metrics and tokenomics. One must also have a view on monetary policy, geopolitical events, and the health of the global economy. This complexity, in turn, makes the asset class more unstable, especially during periods of broad economic uncertainty like the one we are in now. When traditional markets are calm and liquidity is abundant, crypto's macro connection can be a source of strength, allowing it to draft behind bullish sentiment. But when the global outlook is murky and investors are de-risking, crypto's high beta nature means it can experience sharper and more severe drawdowns than its traditional counterparts. To make sense of this new reality, we must move beyond simple narratives and adopt a more structured, multifaceted framework. We need to dissect the market's core components, starting with its structure and the mechanics of liquidity. How is price actually determined? Where is capital positioned? And how does it flow between different assets? Understanding market structure involves identifying key price levels, areas of support and resistance, where significant buying or selling pressure is expected to materialize. It means analyzing trends across different time frames to distinguish between a short-term fluctuation and a major shift in the primary trend. Liquidity is the lifeblood of the market. We must examine the depth of order books, the behavior of market makers, and the flow of stablecoins, which act as the base money of the crypto economy. Without sufficient liquidity, even small orders can cause significant price dislocations, leading to the cascading liquidations that have become a hallmark of crypto market volatility. In the sections that follow, we will systematically break down these critical elements. We will explore the signals that Bitcoin, as the market's undisputed leader, provides through its dominance, futures open interest, and ETF flows. We will segment the vast and diverse altcoin market, from foundational Layer 1 protocols and scaling solutions to emerging narratives in DeFi, artificial intelligence, and gaming. We will dive deep into the world of on-chain analysis, using data from the blockchain itself to gauge network health and investor behavior. We will demystify the derivatives market, looking at funding rates and liquidation heat maps to understand where leverage is concentrated. By assembling these pieces, we can begin to build a more robust and nuanced understanding of the current market regime. This is not about predicting the future, but about constructing a framework to better interpret the present. It is about replacing emotional reactions with methodical analysis, allowing us to navigate this complex and evolving landscape with greater clarity and confidence. If there is one concept that explains most price movement in crypto, it is liquidity. More than narratives, more than technology, more than adoption, the flow of capital is the tide that lifts or grounds all ships in this digital ocean. Understanding its currents is fundamental to navigating the market. It's the invisible force that dictates the intensity and duration of bull and bear cycles. Without a firm grasp of liquidity, we are merely observing the effects, not understanding the cause. But what is liquidity really? It is not just about money existing, it's about money being willing to take risk. Think of it as two distinct pools of capital. The first is the total amount of money in the global financial system, a vast, deep reservoir. The second, much smaller pool is the portion of that money actively seeking higher returns in riskier assets. This is what we call risk-on capital. Crypto, being at the far end of the risk spectrum, is exquisitely sensitive to the size and flow of this second pool. When this pool expands, crypto thrives. When it contracts, crypto struggles. When liquidity is abundant and cheap, investors are pushed out of safe, low-yielding assets and are incentivized to seek higher returns. This environment is typically engineered by central banks through policies like quantitative easing and low interest rates. With the cost of borrowing near zero, capital flows freely, searching for growth. It moves from bonds to stocks, and from large-cap stocks to more speculative assets. Crypto, as the ultimate speculative asset class, benefits immensely from that environment. It acts as a primary destination for capital that has run out of other high-growth opportunities. Conversely, when liquidity tightens, the entire process reverses. Central banks raise interest rates to combat inflation, making borrowing expensive. This is known as quantitative tightening. Risk appetite evaporates almost overnight. Capital becomes defensive, fleeing from speculative assets and seeking safety in cash, short-term government bonds, or the US dollar. For crypto, this is a brutal headwind. The pool of risk-on capital dries up. Order books on exchanges become thinner, meaning smaller sell orders can cause larger price drops. Volatility increases, not to the upside, but in the form of sharp, cascading liquidations. Right now, the global landscape presents a complex picture. Liquidity conditions are mixed, creating a challenging and often contradictory environment for investors. We are no longer in the zero interest rate world of the last decade, but we are also not in a full-blown financial crisis. This ambiguity is key. On one hand, global financial systems are not in a state of acute crisis. Major institutions are stable, and systemic collapse is not an immediate threat. This provides a basic floor, preventing a complete panic-driven exodus from all risk assets. On the other hand, capital is extremely cautious. The primary reason is that borrowing costs remain elevated. With central bank rates holding at multi-year highs, the incentive to borrow and speculate is severely diminished. Cash is king is no longer just a saying. It's a viable strategy, as holding cash or short-term bonds offers a respectable, risk-free return. Consequently, risk tolerance has become highly selective. This creates an environment where crypto can move, but not freely. It's like a car with the engine running but the emergency brake partially engaged. There's enough fuel for short bursts of acceleration, often driven by specific narratives or events, but not enough for a sustained, market-wide rally. Price action becomes choppy and range-bound. Rallies are met with swift profit-taking, and dips are bought but without strong conviction. This is the hallmark of a liquidity-constrained market. Within this constrained environment, a clear hierarchy emerges. Bitcoin, as the largest and most established crypto asset, often absorbs the limited available liquidity first. It's seen as the flight to safety within the crypto space. Investors who want exposure but are still risk-averse will allocate to Bitcoin before considering anything else. Altcoins, which are further down the risk curve, must wait. They typically only see significant capital inflows after Bitcoin has established a clear, stable uptrend, and only if broader market confidence remains high. That sequence is critically important to understand. It's the market's natural rotation of risk. The flow is typically from fiat to Bitcoin, then from Bitcoin to large-cap altcoins like Ethereum, and finally, from large caps into the vast sea of mid- and small-cap altcoins. When liquidity is tight, this rotation often stalls after the first step. Capital flows into Bitcoin and stays there, increasing its dominance over the rest of the market. A sustained altcoin rally, or alt season, is impossible without a preceding powerful wave of broad liquidity that first lifts Bitcoin and then overflows into the rest of the ecosystem. Observing this flow gives us a real-time indicator of the market's true risk appetite. To track these conditions, we look at several key proxies. The total supply of stablecoins like USDT and USDC is a primary indicator. An increasing supply suggests new capital is entering the crypto ecosystem, waiting to be deployed. Conversely, a decreasing supply shows capital is exiting. We also monitor derivatives markets. Positive funding rates for perpetual futures indicate a bullish bias and a willingness to use leverage. Finally, we watch macro indicators like the US dollar index, or DXY. A strong rising dollar typically signals a risk-off environment, acting as a vacuum that pulls liquidity away from assets like crypto. By synthesizing these different data points, we can build a more nuanced and accurate picture of the liquidity landscape, allowing us to better contextualize price action and anticipate major market shifts. Bitcoin is not just another crypto asset. It is the market's signal. When Bitcoin holds strength during uncertain conditions, it suggests underlying confidence. When Bitcoin weakens while risk assets struggle, it often reflects broader fear. Bitcoin dominance. The percentage of the total crypto market represented by Bitcoin provides insight into investor behavior. Rising dominance often signals caution. Declining dominance often signals risk appetite. At the moment, Bitcoin remains central. That tells us investors are still selective. Capital is not flowing indiscriminately into speculation. This is not unusual during transitional phases of market cycles. Altcoins represent innovation, but they also represent risk. Not all altcoins are equal. Some have strong fundamentals. Others rely heavily on narrative and speculation. During uncertain conditions, markets become selective. Capital flows toward perceived quality and away from excessive risk. This creates fragmentation. Some projects perform well, others stagnate. Many underperform expectations. This environment can feel frustrating for investors who expect broad rallies. But it is also a sign of market maturity. Speculation without structure does not last forever. The 4-year cycle is one of the most discussed concepts in crypto. Historically, Bitcoin has moved in patterns influenced by halvings, liquidity, and investor behavior. But cycles are tendencies, not rules. Markets evolve, structures change, external forces intervene. Relying blindly on cycles can lead to poor risk management. Understanding them as context not certainty, is far more useful. Cycles explain behavior, not destiny. Crypto does not exist in isolation. Interest rates influence leverage. Inflation affects capital allocation. Economic growth impacts risk appetite. When financial conditions tighten, speculative assets face pressure. When conditions loosen, risk assets benefit. Crypto responds to these forces, often faster and more aggressively than traditional markets. Understanding macro conditions helps investors avoid emotional decision-making. Volatility is not a flaw in crypto. It is a feature. Markets reward patience, discipline, and perspective. Those who survive crypto cycles are rarely the ones chasing hype. They are the ones managing risk. Understanding where we are matters more than predicting what happens next. Crypto continues to evolve. Uncertainty remains, but uncertainty is not the same as failure. By focusing on structure, liquidity, and behavior, rather than noise, investors can navigate markets with greater clarity. Thank you for watching, and stay informed. Altcoins sit at the intersection of innovation and risk. In constrained liquidity, that tension becomes obvious. Dispersion dominates outcomes. A few names lead, many drift, some disappear. Not all altcoins are equal. Clear products, users, cash discipline. In uncertainty, capital rotates toward perceived quality. Higher beta often lags because hope is not collateral. Fragmentation emerges, shipping features, capturing fees, securing distribution, while a long tail stagnates or underperforms. That gap widens when liquidity is selective. What tends to drive winners now? Product market fit, a reason to exist beyond token incentives. Cash runway, months, not weeks, transparent treasury management. Real usage, distinct cohorts returning without mercenary rewards. Liquidity access, deep exchange books, reliable market makers, sensible emissions. Projects that can prove these points attract stickier flows. Those that can't face gravity. Sector snapshots, briefly. Layer 1s. The bar is higher. Throughput and fees matter. Developer retention and credible neutrality. New L1s must justify parallel ecosystems, not just speed. Legacy L1s trade like macro assets, liquidity in, liquidity out. Layer 2s, cost, latency, user experience, bridge safety, sequencer decentralization timelines, revenue sustainability. Some L2s demonstrate rising transaction density and fee capture from real apps. Others rely on airdrop farming. The market is starting to differentiate. DeFi, the quality spread is wide. Durable fee generation. Audited code, risk frameworks, incentive emissions that recycle into sell pressure are being discounted. Composability helps, but only when counterparty risk is priced and disclosed. AI-adjacent tokens. Interest is high, proof is thin. Data pipelines, inference markets, annotation networks. Projects that only echo the AI narrative without verifiable usage fade when liquidity tightens. Gaming. Long development cycles meet short attention spans. Titles with real retention. On-chain economies that don't hyperinflate. Distribution beyond crypto natives can break through. Tokens tied to pre-product promises struggle as unlocks collide with uncertain timelines. Across all sectors, signals matter more than slogans. Development activity. Consistent commits from core contributors, not bursty vanity stats. Revenue and fees. Recurring, user-driven, with clear take rates. TVL quality, source of capital, stickiness, concentration risk. Exchange liquidity. Depth at best bid, jocks ask. Spread stability during volatility. Unlock schedules, size, cadence, and recipient behavior. User cohorts, retention curves, cost to acquire, non-incentivized engagement. Security posture. Audits, bug bounties, incident response history, upgrade governance. In constrained environments, capital tends to cluster where these signals are strongest. That's why some leaders grind higher while the index feels heavy. It's not just rotation, it's triage. Portfolio implications. Consider a barbell, high-quality large caps on one end, a few high-conviction experiments on the other, or a core satellite, a core of resilient names plus satellite theses. Avoid over-diversification. Many lines that share the same factor exposures don't reduce risk. Size by liquidity and time to proof. Execution details matter. Use staggered entries where books are thin. Respect unlock calendars. Recognize that headline catalysts can be liquidity traps if depth is shallow. Structure over hype. Remember, speculation without structure fades. Sustainability requires data-backed theses. Define what you need to see, and by when, to keep holding. If the metrics stall, reassess. If they improve, let compounding work. As fragmentation persists, patience and selectivity pay more than prediction. You don't need to own everything. You need to own what can endure scarce capital and still grow. In the end, altcoins are a filter for behavior under constraint. The market is telling you where trust, usage, and liquidity are converging. Listen to it. The 4-year cycle is the industry's favorite shorthand. Halving, rally, cooldown, reset. It's tidy, it's familiar, and it's incomplete. Look back at the timeline. 2012, halving. 2016, halving. 2020, halving. Supply issuance stepped down. Narratives clustered around scarcity. Prices trended higher with lags. But across each cycle, liquidity did as much heavy lifting as issuance. When dollar liquidity expanded, crypto found a bid. When it tightened, risk assets, crypto included, compressed. History is useful. In early cycles, small market size amplified reflexivity. Retail flows dominated. Minor sales were a larger share of daily supply. Post-halving supply shocks mattered more. The 2017 run rode exchange proliferation ICOs fresh capital. The 2020-2021 run added institutional on-ramps, derivatives depth, unprecedented global stimulus. Same calendar rhyme, different drivers. Cycles are tendencies, not rules. They reflect a set of recurring conditions, not a guarantee of repetition. Regime changes happen. Market structure evolves. Issuance declines each halving, but minor behavior adapts via hedging and forward sales. Liquidity regimes don't reset on a 4-year clock. Policy credit growth. External forces can overwhelm the template. Rate cycles. Balance sheet moves. Liquidity facilities. These can accelerate or mute risk-taking. ETFs change access speed and breadth, altering who buys and when. Regulatory posture can reroute flows across jurisdictions. Scaling breakthroughs. New primitives, security incidents. These can create mini-cycles inside the larger rhythm. This is where misuse creeps in. Cherry-picking windows to fit the story. Survivorship bias, looking only at assets that made it to today's snapshot, ignoring that thousands of coins from prior cycles never recovered. Treating a post-halving rally as inevitable invites leverage and poor risk control. The cycle talk becomes a cudgel to dismiss data that doesn't conform. A better approach, treat the 4-year cadence as probabilistic context, not a trading signal. Use it to frame expectations for issuance, attention flow of narratives. Then layer the broader model on top. Global liquidity, real yields, credit spreads, fiscal impulse, crypto-native positioning. Ask, does the macro backdrop support sustained risk absorption? Are on-chain users growing without subsidies? Are market depth and derivatives funding aligned with continuation or stretched? Think in scenarios, not predictions. Build bands, base case, modest liquidity tailwind, ETF inflows, steady issuance down bull case. Policy eases faster, risk premium compresses, adoption catalysts, land bear case. Tightening persists, regulation bites, liquidity fractures. For each, define what confirms or invalidates. If a scenario breaks, rotate. Not when the meme changes, but when the data does. Timeframes matter. Investors mixing multi-year theses with intra-week execution often sabotage both. Align the horizon of the thesis with the tools you use. If you're sizing for a 3-year view, don't use stop levels that assume intraday noise is truth. If you're trading short-term, don't rationalize losses with long-term stories. Separate journals, separate risk buckets. Use simple risk rails. Invalidation levels. Price or metric thresholds where your thesis is wrong, not just uncomfortable. Position sizing that assumes slippage in thin books. Scenario weights that update with new information, not emotions. Add-on confirmation cut on breach. Wait when signals conflict. Bring evidence in. Heat maps of liquidity and volatility by year show clustering risk tends to concentrate after halvings, but not on a fixed schedule. ETF flows can be lumpy. They don't run on block rewards. Minor revenue sensitivity shifts with fees. Developer activity can diverge from price for long stretches. These are all inputs. None are destiny. Remember the asymmetry. The cycle framework can help you avoid chasing late, but it can also blind you to early signals that the regime is different. If derivatives open, interest is elevated and funding rich. While liquidity indices roll over, the past cadence won't save you. If spot demand broadens through new channels and volatility compresses on dips, the calendar may understate the opportunity. Context over certainty. Issuance step down. Liquidity trend access channels, regulatory vector tech roadmap. Score them monthly. If scores improve, you can scale within plan. If scores deteriorate, shrink risk even if the calendar says up only. Tendency is not a rule. The takeaway: respect the 4-year narrative as a map of where attention often goes. Policy flows. Depth data. Use cycles to frame probabilities, not to outsource judgment. Manage risk with scenario bands and clear invalidations. Align timeframes. Let evidence lead. Tendency rule. Context. Certainty. Voiceover. Crypto does not exist in isolation. It trades inside a global system of money. It trades inside a global system of credit. It trades inside a global system of policy. To read crypto, you need to read the macro weather. Start with simple anchors. Interest rates set the price of leverage. Higher policy rates raise borrowing costs. Higher rates make cash-like yields more attractive. Higher rates slow risk-taking. Lower rates reduce carry and cash. Lower rates pull investors out along the risk curve. Lower rates cheapen margin. Inflation shapes allocations. Rising inflation pushes some toward hard assets. But if inflation forces tighter policy, it can still pressure risk. Growth steers appetite. Strong, steady growth supports earnings. Strong growth supports confidence. Strong growth supports bid depth. Weak growth tightens budgets. Weak growth shortens holding periods. Think in terms of financial conditions. Tight versus loose. Tightening means higher policy rates. Tightening means shrinking central bank balance sheets. Tightening means wider credit spreads. Tightening means a stronger dollar. Tightening means stricter lending standards. In that regime, speculative assets usually compress. Liquidity thins. Volatility rises on down moves. Reflexive leverage gets pruned. Loosening is the reverse. Policy eases. Liquidity expands. Credit spreads narrow. The dollar softens. Risk tolerance returns. That's when new issuance gets absorbed. Dips get bought. Alt beta outperforms. Key gauges link macro to crypto in real time. The DXY, the US dollar index, is a pressure gauge. A rising dollar tightens global financial conditions, especially for dollar debtors. A rising dollar often correlates with outflows from risk, including crypto. A falling dollar eases conditions and can support inflows. Real yields measure the true return on safe assets. Higher real yields raise the hurdle rate for risk. Higher real yields draw capital toward treasuries. Higher real yields can drain liquidity from crypto. Falling real yields lower that hurdle. Falling real yields tend to support multiples and speculative activity. Liquidity proxies translate policy into market fuel. Central bank balance sheets. Reverse repo usage. Treasury general account swings. Global M2 trends. When aggregate liquidity expands, market depth improves. Funding stresses ease. Crypto's reflexivity works in your favor. When liquidity contracts, marginal buyers step back. Transmission into crypto shows up in prices. Transmission shows up in volumes. Transmission shows up in leverage. In loosening regimes, spot demand broadens. Basis normalizes. Funding turns positive but not extreme. Implied volatility compresses on dips. In tightening regimes, basis collapses. Funding turns flat to negative. Spot to derivatives flow reverses. Liquidations cascade faster. Correlations matter, but they are state-dependent. In disinflationary expansions, crypto often trades like high-beta tech. When macro shocks hit, policy pivots. When macro shocks hit, liquidity facilities. When macro shocks hit, bank stress. Correlation can strengthen as everything prices the same factor. Correlation can break when crypto has idiosyncratic catalysts. Watch rolling correlations over 30-90 days. Rising correlation, macro is in the driver's seat. Falling correlation, crypto-specific flow has the wheel. Build a simple playbook for regimes. Disinflationary growth, inflation cooling, growth steady, policy on hold, or gently easing. Playbook, bias to add-on pullbacks. Playbook, spot-led flows. Playbook, large caps first, then selective alt rotation. Watch for breadth expansion and orderly funding. Stagflation scare. Growth slows while inflation stays sticky. Expect elevated real yields. Expect a stronger dollar. Expect wider credit spreads. Playbook, defense first. Focus on balance sheet strength in crypto majors. Keep leverage low and shorten timeframes. Fade crowded narratives. Stablecoin market share and on-chain organic demand become key filters. Easing cycle. Policy turns decisively easier after stress or slowdown. Liquidity facilities expand and balance sheets stabilize or grow. Credit spreads tighten. Early phase can be messy. Risk assets bottom before the data looks good. Playbook. Scale in as confirmation builds. Watch real yields rolling over. Watch DXY trending down and breadth improving. Expect volatility, but also strong impulse moves. Beta leads, then quality reasserts. Also, plan for acute stress. If funding markets wobble, bank balance sheets tighten, or a dollar spike hits, correlations go to 1. In those windows, survival and position sizing matter more than timing the bottom. When the panic passes and policy response arrives, liquidity impulses can flip the tape quickly. Turn this into a practical dashboard you can check weekly. DXY trend. Uptrend implies tighter global conditions. Downtrend eases. Real rates. 5-year and 10-year TIPS yields. Global liquidity. G5 central bank balance sheets. Treasury general account direction and reverse repo balances. Global M2 growth. Credit spreads. High yield and investment grade spreads. Policy path. Fed funds futures curve and dots versus CPI and labor data. Equities versus Bitcoin. Rolling 60-day correlation and relative strength. Stablecoin supply and velocity. Net issuance and supply share across chains. Funding and basis. Perp funding rates, futures basis, open interest relative to market cap. On-chain demand. Active addresses, fees, and settlement adjusted for incentives. Tie it back to risk. If DXY is trending up, real yields are rising, and credit spreads are widening. Treat rallies as chances to lighten risk. If DXY drifts down, real yields roll over, liquidity expands, and spreads tighten. Scale within plan. Add spot, let winners run, rotate to quality as breadth confirms. Keep definitions clear and reactions systematic. Tightening, higher real yields, stronger dollar, wider spreads, shrinking liquidity. Action, reduce leverage, raise cash buffers, demand evidence before pressing risk. Loosening, lower real yields, softer dollar, tighter spreads, expanding liquidity. Action, increase exposure gradually. Prioritize spot, add-on confirmation. Risk on, breadth up, volatility down on dips, stablecoin supply expanding, funding moderate. Action, rotate selectively, size with invalidations. Risk off, breadth narrowing, volatility up on rallies, stablecoin supply contracting, funding unstable. Action, de-risk, shorten horizon, wait for stabilization. Remember sequencing. Macro impulses hit liquidity first, then spreads, then positioning, then price. Prices can front-run, but sustained trends need confirmation across the dashboard. Use the 4-year cadence as context. Let macro tell you whether the market can absorb risk today. Crypto is reflexive, but reflexivity needs fuel. Track the fuel. Align your horizon to the regime, and let the data, not the calendar, set your pace. Volatility is a feature here. Don't fear it. Price it. Your job is not to predict every move. Your job is to survive long enough to benefit from the moves that matter. Patience is not waiting passively. Patience is structured restraint. Discipline is not rigidity. Discipline is consistent execution of a clear plan. Perspective is earned by staying present through cycles without letting any single candle define your identity. Survivors avoid hype. Survivors budget risk, not opinions. Survivors size positions to withstand being early, wrong, and surprised. Use a simple risk budget. Decide the maximum portfolio drawdown you're willing to tolerate for this strategy. 10 to 20% for a long-only core. Smaller for leveraged or short-term systems. Translate that budget into position sizing, not just stop losses. Position sizing frameworks help you systematize uncertainty. Fixed fractional. Risk a small, constant percent of equity per idea, often 0.25% to 1% to the stop. Volatility scaling. Size smaller in high ATR regimes, larger in calm regimes. Use a 14 or 20-day ATR as the denominator. Tiered entries. Build in thirds as confirmation improves. Reduce if invalidation is close. Define invalidation. Every position should have a price, a time, or a thesis condition that says, "I'm done." Price-based stops for technical breaks. Time-based stops if an expected catalyst passes. Thesis-based exits if the macro regime flips from loosening to tightening. Set circuit breakers at the portfolio level. If you hit a daily or weekly loss threshold, step back. Pause new risk for 24 hours. Review process. Scale position size by 25% until you re-establish rhythm. Rebalancing keeps winners from dominating your future. Choose a cadence, monthly or quarterly, or thresholds. Trim when a position exceeds a set weight. In strong tapes, let runners breathe, but predefine what "let it run" means. In fragile tapes, rebalance more frequently and prioritize durability. Build a core satellite structure. Core in liquid majors with spot exposure and long horizons. Satellites for higher beta bets with smaller sizing, tighter invalidations, and shorter review cycles. If satellites underperform, let them shrink. Don't rescue them with core capital. Keep dry powder. A stablecoin reserve lets you act when liquidity improves. Tie deployments to your dashboard. If DXY rolls over, real yields ease, spreads tighten, breadth expands. Scale plans you wrote in calm, not ideas you improvise in heat. Journaling turns noise into lessons. Keep a simple log. Context. Regime read from your dashboard in one sentence. Plan. Entry. Invalidation. Size. Target conditions, not just targets. Emotion. One word. Anxious, greedy, calm. Outcome. Did you follow the plan? If not, why? Review weekly. Look for repeatable mistakes. Shrink the behaviors that cost you. Reward the ones that compound. Process over prediction. Start each week with the regime. Tightening or loosening, risk on or risk off, breadth improving or narrowing. Your actions flow from the regime. Tightening, risk off, reduce leverage, shorten timeframes, favor core, wait for data to turn. Loosening, risk on. Add gradually, prefer spot. Scale as confirmation builds. Rotate selectively. Use pre-mortems. Liquidity shock, policy surprise, idiosyncratic risk. If any warning shows up on your dashboard, cut size automatically. Make the decision once. Execute many times. Expect clusters. Drawdowns arrive in streaks. Wins do too. Don't increase size because you feel hot. Increase size because your process is in sync with the regime and your edge metrics say so. Hit rate, payoff ratio, and slippage. Think in horizons. Daily noise, weekly signals, quarterly outcomes. Most overtrading happens when you confuse the three. There's no prize for maximal bravery, only for staying solvent and available. Volatility is the toll for returns. Pay it with sizing, patience, and process. When the macro tape loosens and liquidity fuels reflexivity, you'll be standing and sized to participate. When it tightens, you'll still be standing. That's the point. Crypto keeps evolving. New rails, new rules. Same core truth. Uncertainty isn't failure. It's the price of innovation. You don't need perfect calls. You need a durable framework. Anchor to structure. Clear plans. Position sizing defined invalidations. Read liquidity. When dollars loosen and breadth expands, scale with intention. When they tighten, protect longevity. Watch behavior. Your own first. Patience isn't waiting. It's disciplined action on your terms, not the market's. If you keep showing up with a process, the noise stays noise, and the signals compound. Thanks for watching. If this helped you think with more clarity, stay close. Subscribe, turn on alerts, check back as the macro tape shifts. We'll keep it measured, focused, practical, so you can stay informed, sized, and ready. Fade out to the end frame.